see some names from around the world, which is always encouraging to see. My guest this afternoon is Jay Zwiebel, Managing Director of the Harbour Group. I'll say a few words about Harbour in a second, but just so you know that this is recorded and being broadcast live on our Facebook. This particular webinar is one of a series of about 8 that we've done in Hebrew and in English for our multilingual client base. And the recordings are on Facebook, so I'm actually been quite impressed by how many views and how many people are watching the recording. So if you feel this is relevant for anyone, please feel free to share. At any time, you can put a question in the chat and we'll try to address it either during our talk or towards the end. The questions can be anything market or asset class related, or specifically on United States property, which is Jay's expertise. Pioneer and Harbour Group have been working together a long time. I believe Harbour Group is the largest US property player active in the Israeli market by far. I think Jay will correct me if I'm wrong, but something like $13 billion worth of assets and over 1,000 employees in the United States. So that puts them in a totally different league compared to the very many property players in the local market here. And we know from our client base that many like to invest in property. Property is part of everybody's asset allocation plan. And so property is on the minds of many investors. And my personal view is that property is always part of the solution. A lot of people like to compare, should they be in property or should they be in liquid markets? Well, they're not comparable. So we like to see different asset classes in a wealth planning portfolio. So they don't necessarily compete. Okay, so the agenda, I'm going to give a little macro view. For those of you who attended previous webinars, you might find a little bit of a repetition there because my macro view has not changed all that much over the last 8 weeks. And then Jay is going to give us some insight into the US property market. And should existing investors be concerned, what sort of opportunities out there, and all of those sort of things he'll address. So without further ado, let me just start my presentation. And if anybody has any sound issues or logistics, just send it in the chat and we'll see if we can deal with it. Okay, on we go. So the first thing is to just have a quick review of the virus numbers. This is from last night when I was preparing this slide. Today we've crossed 9 million confirmed cases internationally. If you look at the daily cases, a clear, strong upward trend globally. And you can see this part here in April, May, when the world was in lockdown, it's kind of flattened, but now we're definitely on a strong upward trajectory around the world. However, on the positive note, there's kind of a downward trajectory on the number of deaths. I was discussing this with a medical expert, and he said, Doc, the hospitals are getting better at treating it, and it's not always a case of needing a ventilator. At the beginning of this crisis, it was all about no steroids, and you needed ventilators. Now they're learning that you don't necessarily need ventilators and you do need steroids. So they're getting better. So hopefully that's a little bit of optimism in the scenario. And of course, when reviewing virus numbers, the numbers today are not the point. The point is always the trajectory and where we're going to be in 6 or 9 months' time. And it's clear to me that, I think to most people, that where the numbers are going to be significantly worse as we approach the end of the year. These numbers will probably double, closer to the 20 million mark, whereas the number of deaths hopefully won't double, but it will certainly be in the high $100,000, unfortunately. Having a little look at some of the countries that might be interest of the people on this call. This particular graph is from an interesting website called Our World in Data, and you can manipulate the graph in various ways. So this is per million of population, compared South Africa, United States, United Kingdom, and Israel. And you can see a clear trend of what's happening. United States came down back to an upward trend. South Africa, very strong upward trend. Israel, on a per capita basis, has actually overtaken the United Kingdom right now. So that's kind of interesting. So the United Kingdom has been on a strong downward trend. The color of the line here indicates the number of tests relative to the size of the population. The orange and the reds indicate that they're not testing enough. So even though the United States has done 27 million tests, it's not nearly enough given the size of their population. Whereas Israel have done enough tests relative to our size of population, and we should get some comfort in the numbers. Just an interesting statistic that stood out. Brazil has performed 1.8 million tests, but they got 1 million cases. So that's nearly a 50% positive result, which is very, very scary for the outlook of Brazil. What are the implications going forward for the economy? I think it's becoming clear that this is a longer term problem. The bite is only starting to be felt economically. The legal fights, if you speak to lawyers, they're saying the legal fights are just starting. And it's a bit of a longer term. We're all starting to accept that this is a longer term problem. When the market rebounded in April, everyone was saying, yeah, the economy would normalize by the late summer. And now it's looking, I think we're beginning to accept that this virus is going to be around for a while. And that puts a little bit of a sobering view on things. It slows down the rate that companies reemploy people. And the unemployment numbers are likely to stay high till the end of the year. So double-digit unemployment, both in the United States and in Israel towards the end of the year. And that's certainly going to put people under strain. Governments are realizing the high cost of a lockdown, and they're reluctant to put further lockdowns. I know Israel's threatening it in various forms, but I think that the public is less cooperative and the governments are less keen. So as we face our second wave of viruses in Israel and potentially in other places, there's going to be localized solutions. So if the virus pops up in a school, they'll close down that school. If it pops up in a workplace, they'll close down that workplace. And we'll have to get used to that type of behavior. There might be greater enforcement. I understand that in Renana, they started giving people tickets for not wearing masks. And those are the type of things we're just going to have to get used to. Long-term travel restrictions. So even though I understand you can book flights now from the 1st of August out of Israel, travel is only going to be for people who really, 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 really need to. There's going to be a lot of restrictions, which are not going to be a pleasant experience. Wearing a mask for 10 hours on a plane is not a pleasant experience. And then, of course, social unrest. So we've seen social unrest of late. I think that had there been no corona, the level of social unrest that we'd seen in the United States would have been far less. The fact that so many people are unemployed, an anti-establishment agenda within, or a Marxist agenda, even within the Black Lives Matter organizations, have hijacked it, and we've seen social unrest. So it doesn't matter what the reason, there's going to be bits of social unrest around the world, which is certainly bad for business and possibly not great for the markets either. Okay, what about the markets? So the uncertainty of the virus and the long-term nature of it is certainly going to be a cloud over the uncertainty of economic normalization. So it'll take a while, I think, is the conclusion. And there's, on the other hand, there's massive amounts of bailout money, absolutely staggering amounts of bailout money coming out of the United States. Europe are in negotiations for a massive, unprecedented bailout package. And markets are functioning. There's been new IPOs. There have been large-scale restructuring of certain companies. They've used capital markets to restructure debt. So markets are functioning. Financial services are very strong. The Fed is buying all types of bonds, particularly investment-grade corporate bonds directly now. This provides immense stability, and it's not a systemic risk. So we feel that basic asset allocation principles, meaning how much of your portfolio is in stocks and bonds, taking a long-term view, all those fundamentals are still absolutely in place. We firmly believe that. So We're taking a long-term view, and markets are functioning, asset allocation is still working. Just having a look at how markets have done year to date. This is always a conversation point with clients. We've got the red line being NASDAQ, which is in positive territory. You can see the sharp correction here. This on the right-hand side, last week, the markets fell 5% in one day. But in the context of year to date, it's not such a bad deal at all. And the markets are kind of showing business as usual. There's no major number here that indicates the scale of the economic squeeze that's happening around us. So perhaps that's all based on the government support, but taking an even longer term view, 1 year view, you can see that the NASDAQ's in positive territory, very strong positive territory. The S&P is in very, 10%, S&P 500, and the emerging markets line is flat. So again, taking a 1 year view, if you closed your eyes and woke up, if you went to sleep a year ago and woke up today, you really have no indication in your global portfolio, at least in the equities, that there's any sort of problem whatsoever. So this conversation point comes up almost every meeting. Why are markets so high? And market participants like us, we have a long-term constructive view. We've got money that needs to be invested, long-term money. The recovery will come, whether it's in August or in November or in January. The full recovery will come. The economic activity is already happening. There's a tremendous amount of money seeking returns. I know it from my personal experience with high net worth individuals, with the institutions we deal with. There's a lot of cash seeking returns. So that's always going to find its way into the market. And of course, the long-term view. The policy contribution that I mentioned already, massive amounts of credit and money creation by central banks, European and America are far ahead of everyone else. This excess cash is being invested. In addition, there's fiscal life support in the form of tax relief, and the United States has actually dished out helicopter money, a few $1,000s to every citizen, even if you don't live in the United States. And even if your particular state has not been hit that hard by the virus, you still get and qualify for federal support. So that's kind of interesting. Looking forward in my crystal ball, what do I think for going forward? I think that interest rates are likely to stay close to zero, very, very low. So Jay can comment what that means for the property market. I think that equities, there's going to be some volatility, but we continue to be invested in equities. We do favor United States over non-USA. It's still the strongest economy. You can say what you like about Trump, but it's still the strongest economy. The market is still pricing in shorter economic damage rather than longer. So that means months rather than years. This is the point that creates the volatility. Elections coming up in November. The information is that Biden is ahead on votes, but we're not sure how that translates through to electoral colleges. Jay, maybe he can comment on that. I don't know. And what it might mean for the property market. But either way, given the state of the US economy, we kind of think that whoever wins, it will be a market-friendly policies. Debatable whether when they will increase taxes. I think they will, but debatable when it will happen. So we'll have to listen to see what Biden promises in terms of taxes. Chinese tensions, it's higher than ever, but we kind of like China, and I'm happy to discuss that if need be, but we think it's a strong diversifier for a typical dollar portfolio. And inflation, there's no sign of inflation anytime soon. Obviously, with the amount of quantitative easing and monetary policy moves that they're doing, inflation is a concern, and we'll just have to keep an eye on it. Ironically, if inflation happens, then you need to be short on your bonds, which we are, and more equities in your portfolio, which we have. So it's not a terrible concern, but I think that that's a long-term concern. That's not a short-term concern. And as I said, increasing taxes are likely. What to do, just to summarize, remain focused on your long-term goal. Asset allocation still works. The clients we deal with, everybody seems to have a currency question. The currencies, there's a lot of debate whether the dollar will weaken. I think that the dollar will remain relatively strong. Everyone seems to be weakening together. So I don't think there's a major chance of a huge currency swing. We remain optimistic for the long term and cautious for the short term. We're underweight equities versus benchmarks in our global portfolio, underweight risk, I should say. And we're fully invested in bonds. We think that bonds offer value compared to cash right now. And we're looking for opportunities. So don't bet against the United States is also a theme that comes through in our portfolios. And we're looking at all the alternatives, the liquid alternatives and the illiquid alternatives for alternative sources of yield. We like structured notes, we like certain specialist funds, and of course, property, as I said in the introduction, property is an important part of every portfolio. As an investor in property, I would say I have some concerns. I'd like to know what, should we wait? I think I'd like Jay, at that point, I'm going to hand over to Jay and he can let us know what should a property investor do. All right, over to you, Jay. Let me just cancel my screen sharing.
Thank you.
And over to you.
Thank you, Mike. Hi, everyone. So my name is Jay Zwiebel. I'm a partner at Harbor Group International. We manage a $12.5 billion portfolio of real estate. In the United States, we have more than 1,000 employees. And I guess relevant to this talk, we are involved in equity, meaning buying real estate directly, which includes multifamily, office, to some extent, some retail. We have a very large portfolio of debt, loans, preferred equity. So it kind of gives us a broad perspective on what we're seeing in the market. So when we talk about implications on commercial real estate, well, first I'll start by saying that I think what we're seeing in COVID-19 is extremely dynamic, and things that we think are correct today are going to be wrong tomorrow. So let's just put that and whatever we say today into perspective. The second thing I would say is that we're talking about real estate. We really need to differentiate between the different asset classes. So we have a multifamily, office, hospitality, retail. Today we'll touch, or at least focus at least on three, which will be multifamily, office, and retail. So what we have done, and I think others have done going into this new era of COVID-19, is beginning of March, I think, again, we, but others as well, noticed where these markets are going to, expecting for the worst. What we have done and others have done as well is to cut expenses, to seize all capital work, any value add projects we had. On the one hand, on the other hand, what we were trying to do, mostly in multifamily, is to try to encourage the tenants to increase their, or to extend their leases with us. So at least they were in with us for another 12 months for that period. We didn't, of course, increase rents. We didn't reduce them at the time. But one of our goals was to try to get the tenants to extend their leases. So I think going into COVID-19, at least we, and I think others, were definitely ready in terms of cutting expenses. One interesting thing to do is to look at where we were pre-COVID-19 as compared to the pre-global financial crisis in 2007. So one interesting data is the debt service coverage ratios, which is the free cash flow a property has and divided by the debt service. So if you have $1 of income and you have $1 of debt service, then your debt service coverage ratio is 1. So if we compare 2007 to 2019, the debt service coverage ratios, at least we'll talk about the three main asset classes, office, residential, and hotel, were basically today are 2 times more than they were in 2007. So it means the companies have a lot of room for error, a lot of room for the income to go down before they go into actual hardship. Another interesting data point is that again, I mean, the transactions are higher now, the prices are higher. What's really interesting, and it started at the end of 2020, end of 2019, where the belief was we're going to a very strong year, but even more stronger now during the COVID-19 months, is that there's a lot of dry powder waiting on the sidelines for deals. I mean, we've raised $1 billion just now for deals, and others have as well. So there's a lot of dry powder waiting to go into real estate deals. We'll discuss as we progress a little about, are there any deals at this point? But at least there is a lot of money waiting for deals. So I think we are in a better position today where we were in 2008. And of course, the main difference is that at the time, the crisis was caused by financial crisis. Currently, what happened now is the economies were doing well, and the crisis came from somewhere else. So some of the impacts of COVID-19, I will start with lending. The lender markets, on the one hand, you can continue to get financing. However, the proceeds went down. And there are some types of deals that were very hard to get financing, specifically in the multifamily world. It's new development, and it's also new properties that are in lease up. So for us as lenders, we have and still see opportunities in those two areas of new deals, and more importantly to us is in deals that are brand new, started lease up six months ago, and the developer is trying to refi his construction loan. So the lending market has come back a little, but at least again, those two types of financing are very hard for borrowers to find. In terms of liquidity, we did see more of a short-term liquidity issue. It specifically, or I would say mostly in the retail and hospitality industries. Many borrowers were at a point where they had a lot of difficulty making their debt service payments, again, specifically in those two types of asset classes. In terms of the leasing volume, of course, since this all started, there's not a lot of leasing. We are seeing office tenants starting to come back to the table and discuss their renewals or their new leases. But again, of course, it's a little slower than what we've seen prior to March. In terms of the cap rates, again, like I mentioned before, mostly we've seen a lot of distress in hospitality and retail. To a lesser extent in other asset classes, simply because there are not a lot of deals happening. We do expect to see some increases in cap rates in multifamily, perhaps in office as well. But what we're seeing now is they can be somewhere between 50 basis points to 100 basis points. But don't forget, this is also going on lower income, because rents definitely are not going up. And in some markets, we may even see them going down. In terms of investments, the investment market is kind of dead. Most of the deals that we're seeing now are in the debt world, like I mentioned before. It's providing new debt to developers that just completed a property and starting lease up. It could be a new properties. We even have seen some sponsors that were under contract to buy a property, and then their senior debt either reduced the proceeds or couldn't close the deal, and they also had some distress in raising debt. In terms of equity deals, we see a lot of them. Currently, we haven't been able to close on any deal. Again, I assume it's a question of time. Maybe by the end of this year, we'll start to see deals that have to sell. Currently, at this point, if you don't have to sell a property, you're not going to sell. In terms of operations, like I mentioned before, we and others have cut expenses, at least have come into this crisis as ready as we can. And of course, hotels and retail for sure doing very difficult. So in terms of retail, this has been a perfect storm for the retail industry. Going into 2020, for the last 5 years, the e-commerce has been eating a lot of the income from the stores. But when then came COVID-19, we've seen a huge decline in sales. So in April, the sales declined by 16.6% compared to the previous month, which was also down. And out of that, if you look at the right, you'll see, and not surprisingly, that the largest decline was in retail, in clothing stores. Those went down by 89%. The gainers, again, not a big surprise, are the e-commerce merchants and the food and beverages that we're doing relatively okay. But what we've seen that happened and what happened the last few months, and no offense to anyone who's a grandfather or mother, but what we've seen is that our grandparents learned that they can buy anything online. And that really had and will have a longer term impact on stores and on retail. So I think that's definitely one industry we need to assume that will not be the same going forward. I assume we'll see some improvement, but again, we should assume that it's not going to be like it was prior. In terms of office, the question we're asking ourselves is, what will office look like in the future, and will people continue to work from home? So the CEO of Facebook and the founder sent an email to those employees announcing that he believes that in the next 5 to 10 years, 50% of their employees will be working from home. However, he says there are a few challenges. One is that it's never a clear boundary of when you're working and when you're not working when you're at home. And the second is that he stresses the importance of the interaction between people. And the same came up in a letter to the editor of Financial Times in London in May, when he wrote, on the one hand, he was happy to see that many people can work from home. However, he writes, and I like that term, it's the increasingly evident lack of unstructured interactions. And I think that's part of something that we all feel that we need at work. And that's something that if at the beginning of March, the feeling was, well, heck, this is great. As we progressed, people feel the need to work from the office. So Gallup had you could look at the poll they had, and you could see that at the beginning in March, 38% felt that they would want to go back to the office, and by mid-April, it's 49%. So on the one hand, it will look different, and I think people did discover that they can work from home. However, there are a few advantages to working from the office. And one is control. You can actually control your employees. The employees are more focused, better collaboration, social bonds between the employees, and the ability to formally and informally learn from others at the office. So office buildings are still going to be around and still going to be occupied. It may be different. However, I think we both assume that at a certain point, there will be a new normal. It may not be what we had 2 months ago and not what we had 4 months ago, but it will be a new normal. In terms of what we've seen in our portfolio is that, to the extent most of our tenants are large tenants like Amazon and JP Morgan and other banks. So in terms of the larger tenants, we didn't see any hardship. They've made their rent payments on time. The only tenants that had issues were like mentioned before, the retail. Every office building, or most office buildings, have some retail components to them, and those did have hardship. And the second are the office buildings, the office tenants, specifically the fitness centers and the co-working offices. Both, of course, had difficulties. Aside for that, at least in our portfolio, we haven't seen any issue. Of course, the more you deal with smaller and many tenants, one would be more impacted by by the COVID-19. Multifamily has been a very, I would say, a pleasant surprise for us. When I mentioned getting ready in March for what's going to happen, we ran stress tests on rental collections. We ran stress tests assuming we collect only 70% of the rent, and that's how we build our projections and our distributions. But so far, April, May, and June have been very strong months. So if you compare April this year to last year, 94.6 collected in this year compared to 97.7. May this year was 95.1 compared to 96.6. In June, the last figure I have is from last Thursday. As of last Thursday, which was the 17th, we were at 88% collections. That's compared to 88.7 collections in May. So collections are very strong. And a lot of that is thanks to the US government that's been writing checks to essentially the president, who personally has been writing checks to the Americans, also in terms of the one-time payment, also in terms of the unemployment. I was asked what markets we feel are more resilient. So what we're seeing, strong markets are, and we're hearing from others, is Phoenix is an extremely strong market. It has a strong attraction because of its low tax rates or an comfortable tax regime compared especially to California. In our portfolio, we're seeing very strong collections in Columbus, Ohio, a market very dependent on governmental and on universities. In DC is doing very well as well. So again, the markets that are more resilient, I guess, are either markets that have good tax regime or dependent less on industry that have been hit, like airports and hospitality. Freddie Mac in March announced a forbearance program, and they gave the borrowers an opportunity to defer their debt service payments for 3 months and then pay those 3 months over a 12-month period. The criteria, they said, would be very easy. All you need to do is to prove hardship or show hardship, and they would give you the ability to forbear your debt. As of May 26, only 2.1% of the total unpaid principal balance were forborne. So that means that a large majority of the borrowers were able to meet the debt service payments. In the table, you see a breakdown. I won't go into details, but at least the SB deals and the multi-PCs. Those are small deals with very few tenants, and that's why the percentage is higher there, because 1 or 2 tenants that don't pay has a strong effect on the ability of the landlord to make its debt service payments. However, if you look at the K deal, the Q deal, you'll see that the percentages are very low. And overall, we're still talking about only 2.1%. So the multifamily industry or asset class has been doing very, very well. Part of it is also due to the strong fundamentals going into this COVID-19. Very low home ownership percentages, driven or which caused the rents to be relatively high, occupancy rates to be high, which leaves us a lot of room for error going forward. So looking back, we've seen strong collections, but we can assume that going forward, we will start to see a drop in occupancy due to people going to move with their parents. But again, there's still a lot of room in both rental income and in occupancies for these markets to stay strong. Another good data point is the retention of these residents. And again, this has been a percentage that's growing in the past 10 years. So again, going into this COVID-19 crisis, the retention was 52%. I could tell you that during the COVID-19 months, the retention ratio was much higher. The tenants didn't go anywhere. And we should assume that will change going forward a little. So again, a multifamily, very strong tailwinds. Home ownership is still going down or lower than what it was 10 years ago. People still prefer to rent. It gives them more flexibility. I think they've seen in hard times, it's easier to make your rent payments, move to a cheaper apartment than have to continue to make your mortgage payments on your house. So that more or less is what we've seen. So we, like I said, retail, very difficult. Office, at least in the strong tenants, you're not seeing too many difficulties at all. May see some change in how people use office in the future. Multifamily has been and still extremely strong, and going forward should assume, one, for sure not seeing strong rental increases in the next 6 to 12 months, and may see some drops in occupancies. I was asked about new deals, when we'll see new deals. I think I mentioned this already, but we have been seeing debt deals. So during the real difficult months, I mean, specifically the end of March, beginning of April, we're actually able to buy some debt at real big discounts. We're able to do that until the government of the United States just bought every bond in the world. Until then, we have seen deals like that. Since then, we've been made some offers and actually were awarded a few preferred equity and mezzanine deals. So again, still in the debt world. In terms of equity, it may take some time. I believe towards the end of this year, we will start to see deals in that world as well. The fund of 2020, another question I was asked. We've called 45% of the equity. I would say 20 to 25% of that is in deals post-COVID. The balance was a big deal we did in January, another deal we did in February.
Can you, just for those people on the call who are not aware, Harbor Group have launched a fund every January for the last, I think, 15 years, right? Is that correct?
Yeah, 2006 we started.
So for the last 15 years, they launch a fund every year that invests in all their deals throughout the year. So when Jay's referring to his 2020 deal, that's that particular fund. So as an investor, I like that sort of, there's a fund per year. Interestingly, Jay, you may want to point out what you did with your 2007 vintage fund. What happened as it went into 2008 crisis.
Right. So our worst year, and because this is online, I'm kind of careful in giving any actual returns. But our worst year was 2008 vintage and 2007. We still were able to achieve positive returns in those years. It took us longer to sell. But at the end of the day, we did achieve positive returns. I don't think we're at 2007 or 8. I think we will do better, but the implication may be that it will take longer to sell the properties. We'll hold on longer. We may even foreclose on some properties, which would be great if we have the opportunity, and we are looking at some of those opportunities as well. So I think we are well capitalized. Our leverage is not too high. We're in a good position on a capital stack. So I think we have. I think we'll do well. And then again, the only implication may be that it will take us longer to sell.
And Jay, the multifamily space, pre-corona, what was the range of cap rates of the deals you were looking at, and what is the post-corona range of cap rates you were looking at?
I would say pre-corona 4 to 4.5, post 5 to 5.5. But the income is lower. Again, that may change, but at least that's what we believe we will see. Okay.
We got another question here from a listener about the shekel dollar rate. Something I really don't like doing is making currency predictions. It's exceptionally difficult. There's 3 major players in the currency market. The biggest are the central banks, so the Israel central bank is the biggest player. Then there's currency speculators, and then there's people who trade, so people who are importing or exporting. So all of that impacts the rate, and it's exceptionally difficult to predict. But having said that, I think that I don't see a major swing. Yes, the dollar should weaken, which would mean the shekel strengthens and goes down to the low 3.4s. But as Israel gets down to those levels, the Israeli economy weakens, so it gets back to its sort of comfort range of around 3.5. A very, very difficult thing to predict in the short term, but I think it'll be range bound between 3.4 and 3.55. It's hard to imagine the 3.75, 3.78 that we saw in March for a very, very brief period. So who knows, but that's my view on that. Any other questions? No. Okay. So thank you all. Thank you, Jay.
Thank you, Mike.
And if anybody has any follow-up questions to me or Jay, they can contact us. Thank you, and stay healthy.
Thank you very much. Bye.